Welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization and the blockchain revolution. I'm Friederike Ernst, and today I'm speaking with Michael Svoboda, who is the CEO of Liquity AG.
Banking is under pressure. Stablecoin is a much better product than having your dollars in your bank, because there you have the counterparty risk, and this bank, in Germany, might lend the money to Benko. We had this huge scandal and you're not aware of it. We see these forces now playing out with Genius Act, with Clarity Act. Honestly, it's not about the users. Regulation is actually used to protect the banks or create the moat. Liquity just follows 100% of the borrower's fees to the stablecoin holders to facilitate that peer-to-peer credit market. It's very hard, it's a very competitive market, but that's why we tried with Liquity V2 and Bold to have a very clear and distinct value proposition, rather serve a niche, but be very clear.
Liquity, the protocol, is a governance-free Ethereum protocol that lets users borrow a decentralized dollar against ETH at self-set interest rates. Before I talk with Michael, let me tell you about our sponsors this week.
This episode is brought to you by Lido. As Ethereum staking continues to evolve, more teams building staking products are running into a familiar challenge. On one hand, pooled liquid staking gives you liquidity and access to DeFi, but can limit customization. And on the other, bespoke staking setups offer more control over things like pricing, performance, and operator selection, but they often come with added complexity and less flexibility. Lido V3 is changing that with ST Vaults. ST Vaults is modular staking infrastructure. It lets builders and institutions deploy custom staking vaults tailored to their specific needs. At the same time, they're staying connected to SDETH as a shared liquidity layer powering Ethereum's broader DeFi ecosystem. If you're just looking for a place to generate yield on your idle assets, Lido Earn makes it super simple. It offers curated DeFi strategies built around SDETH. You deposit once, you choose a vault, and manage everything from a single interface. To learn more and start building with ST Vaults, go to lido.fi/ST Vaults and get in touch with Lido contributors today.
Hi, Michael. It's good to have you on the show.
Hi, Friederike. Thank you for having me.
Cool. Before we dive in, who are you and what originally got you interested in all of this?
Yeah, so I'm Michael. I live in Switzerland, and I was working in a normal corporate telecommunications in the digital space. And we were talking about disruption, and I was talking to B2B clients about disruption, and then I heard about blockchain, and I realized this is really the only disruptive thing that is happening right now, like the internet, which took out intermediaries for comms and media. This will take out intermediaries in finance, and that fascinated me. And then I quit my job because it's not going to happen in this big corporate, and I jumped into the crypto world. I think that was 2019, around the ICO craze.
Liquity itself was founded, I believe, a year or two earlier, right?
Yeah.
By Robert, who's still with Liquity, but in a more researchery background role. Can you talk about the original rationale for the founding of Liquity? So what did Robert feel was fundamentally broken or missing in how on-chain credit and stablecoins were being built at the time?
First, I think he was really fascinated by blockchain. So he was working before for Divinity on the consensus algorithms. And then I think the MiCA kind of sparked his interest. Being able to issue your own stablecoin, be your own national bank, I think was a very cool concept. He saw that and he just immediately came up with ideas and said, hey, we have blockchain technologies. Why do we need governance? Can't we automate that? Maybe we can also make it interest-free. Do we need to have interest? You can break with all these paradigms. And he also thought he can create a higher loan-to-value ratio. So with these propositions, he set out to create a more efficient, more autonomous borrowing protocol that was very similar, like single collateral DAI. And that's what he did, what he set out, and it was launched in 2021, was been running since then and managed more than 5 billion in TVL, has its own stablecoin, LUSD.
But what, talking about like this early MiCA era, there were a couple of events that must have shaped how Robert and then also you thought about protocol design, right? Kind of like there was the infamous Black Thursday that kind of led to the rise of DPEG tools. So MiCA still has the PSM, yes, the peg stability module. What lessons did you take away from watching MiCA evolve in real time?
Yeah, I mean, Maker set out to follow a path, maybe more of growth, taking in more diverse collateral, getting exposure to TradFi, which helped their growth. They also introduced the PSM with USDC, a centralized stablecoin to keep the peg, I think, which helps the product. But I think Robert was very Ethereum aligned and just wanted to get out most of the technology, creating like the most Ethereum dollar-like money you can get, by reducing all intermediaries and all kind of dependencies. But one big learning that we learned, and that also kind of got introduced in V2, it was, for example, we had these interest-free loans. So you had only a one-off fee, which was very interesting. If you talk to TradFi people and you said, you don't pay any interest, it was like totally puzzling for them. That was very viable in a low interest rate environment. And when these rates kind of raised, then the protocol wasn't designed for that. It still works, but it had drawbacks on the collateralization ratio. So a learning was there, how can we design the interest rates in a more dynamic way to create an equilibrium or have a rate and a peg that can better self-regulate itself. And that was definitely a learning. And I think, again, what I really like, why I joined Liquity, is all this innovation, interest-freeness. And then with V2, we have user-set interest rates, also something very cool. Go to your bank and say, hey, I would like to have this interest rate. That's something you can do. And that was also a decision. Again, a lot of protocols set the rates by governance or by utilization, and then it spikes. And we took really a market approach. Who's the best to decide which rate we should have in DeFi? So we let the users decide.
Okay, maybe let's dive into how that works in just a second, but let's just contrast that to how MiCA and Aave do it, right? Kind of like the two main players in this arena, right? So basically in MiCA, the interest rate is set by governance, and kind of like it's fairly slow moving. It feels a little central bankish to me sometimes. There's a lot of governance. And in Aave, it's algorithmic, but that also means it can spike unpredictably. So kind of if you take out a loan and initially your rate was, I don't know, 5%, it's possible it kind of spikes to 10% or 15%, and there's nothing you can do other than kind of repay the loan and kind of get out from under it. Let's kind of walk me through how the mechanics of Liquity work end to end. So kind of, I know that the range of collateral that I can deposit is very limited. So say I have ETH or some sort of wrapped staked ETH token. And I want to borrow USD. What actually happens step by step inside the protocol?
So like with every collateralized debt position protocol or CDP position, you come with your collateral. So ETH or wrapped staked ETH or ETH, we only have these three collateral to, again, don't have dependencies on other collateral that we feel are less safe. So kind of as Ethereum native as possible. And you self-issue a loan. So you deposit the collateral into the protocol where it's held, where it's not lent out, it's always there. And then you can take out the loan up to 90% loan to value. So let's say you put in 50K in ETH, you take out a loan of 25K, you get that in the protocol stablecoin Bolt, and then you can set a rate. So you can say, okay, I will have, for example, 3%. You do that, you get the Bolt. Usually what you do, because you take out a loan, because you need liquidity, you will swap it to another stablecoin, off-ramp into fiat, for example. Or if you say, I get a cheap borrowing rate, I don't know, right now it's 3% on ETH, which is low, you could farm somewhere else for 10%, and that could be also your use case. So that's the borrowing side. I think that's quite straightforward and simple, and maybe the question people ask now, okay, how do I set the rate?
Yes.
Why is not everybody setting it to zero?
Exactly. This would have been my first question. So kind of like if someone tells me you can borrow money here, what what kind of interest do you want to pay? I would go like, 0. Why don't people do that?
Yeah, so for that, we need to look on the other side. We're really a market, a peer-to-peer finance market. So we have the borrower. On the other side, we have the stablecoin holder, because essentially if you want fiat, you sell the stablecoin and then somebody needs to hold it. It can't disappear. If everybody sells it and nobody holds it, then it depegs. So it's like the stablecoin holder is like your creditor on the other side. And now you both need to agree on the right rate, because if the rate is not high enough, nobody will hold it. So borrowers have an interest to pay enough yield, because there is like a stick. You have like the carrot and the stick. So stablecoin holders have a stick. If the stablecoin depegs below 1, everybody has the right to redeem the stablecoin at face value. So that's also something that you don't have in many protocols. You can come with the dollar and you get really the underlying collateral. Try to do that with your fiat or your USDT. And this is called redemption. So if I have 10,000 in bold that is below peg, I can go to the protocol and say, okay, I want now, this is only worth 9,500. I want 10,000 in ETH as from the collateral, and I can exchange that. And this redemption hits the borrower with the lowest rate. So you see kind of the stablecoin holders are chasing the ones that think I have the lowest rate. They have also the highest risk. They get redeemed. They don't have kind of a economical, that's not an economical penalty. It's not a liquidation where you lose 5% of the value, but you just lose the exposure of your underlying ETH, which can be also, for some people, they want to avoid that. So if people see that, oh, I get redeemed, I'm really low, I'm going to higher my rate, and this protects me from the redemption. So you have now this market where borrowers adjust and stablecoin holders with the redemptions are driving the rate. So you have really market-driven rates, and it's like a two-sided market of borrowers and the stablecoin holders, the creditors. And I think it's one of the first time I've seen that being implemented like that. And the beauty is it's actually very direct. These parties talk together. If you think about it like how it's done in other protocols, as you said, okay, I don't know, stablecoin depegs, or we have a problem, there is a governance proposal, we increase the rate, the yield funnels through a complex system, while in Liquity just funnels 100% of the borrower's fees to the stablecoin holders to facilitate that peer-to-peer credit market at the end.
I have a couple of questions. So maybe let's kind of ply this apart a little bit. If BOLT doesn't trade below $1, but at $1 or above $1, there are no redemptions, right? Kind of like I am not at risk of having my collateral kind of sold, right?
Mm-hmm. Your loan gets repaid kind of from a third party. Yeah. You have less debt, but you also have less collateral.
Okay, but if BOLT trades above $1 or at $1, this doesn't happen, right? This only happens kind of at depeg, kind of at negative depeg. Why, if I don't expect this to happen, if I don't think this will happen, why am I setting an interest rate at all? Am I at risk of not being matched if I don't set an interest rate?
No. So if the stablecoin is above, then people or kind of advanced users will set really low rates. They can benefit, because they can't get redeemed. But this means now the borrowing fees and the yield that is paid out gets smaller until it flips. But this kind of reduced the problem that we had in V1, that the stablecoin could depeg above. So this happens now very rarely, and the peg is quite good for a decentralized one that is not pegged to any, kind of treasuries or centralized stablecoin. So this puts then the pressure down. More people are probably selling the stablecoin because they don't have enough yield. Then it goes below peg. And then you have the opposite mechanism, the ones that set it low now racing again on the top. And then you're getting this balance.
So if you compare the current rates with protocols like MiCA and Aave, where are we at with Liquity?
Yeah, so Aave is much more volatile, so you don't get that much. I think it's quite low on average. MiCA I had to look up, but usually, so the proposition of the borrower side is that Liquity had always quite low and predictable rates because it's also so efficient. The system is not taxed. Nobody's taking away revenue, so the spreads are really low. So I think I don't know. Right now with the markets, I haven't looked up, but a month ago, maybe, MiCA was at 5% for ETH and Liquidity was at 3%.
Why do you think kind of forced deleveraging through redemptions is a better failure mode than the traditional liquidation cascades that we see in the other CDP protocols when loans are underwater?
Yeah, so these are two different mechanisms. And we also, Liquidity has also liquidations. And liquidations are here if your collateralization ratio that is backing the stablecoin gets too low. So then, like in every protocol, you get liquidated. There is a margin call, and then your collateral is taken away, and you're taking a haircut, and your position is wiped out. But that's something different. That's the over collateralization, loan to value. And that happens just to your trove and is dependent on your collateralization ratio. Redemptions, everybody can do redemption, and that has to do with the peg, and only the ones that have low interest rates are targeted. So these are two different mechanisms. Why do we have them? Exactly to let the market define the market rate, to not need a governance, to be able to do that algorithmically or let the market decide, and also to introduce, I think, a really nice feature not many stablecoins have, that every user has the right and can instantly redeem for the underlying collateral. That's the redemption mechanism, and it helps the peg and not the over collateralization of the protocol. For that's liquidations, like in any protocol.
So you have deliberately only a very small set of collateral options, right? So kind of like as someone who now wants to redeem collateral because Bolt is trading below $1, do I have to take the lowest interest vault, or can I choose which collateral I want to get back? Because it's possible that kind of, I mean, the probability is low, but it's possible that kind of like one of the liquid staking tokens kind of has a problem, right?
Sure. So V1 was only ETH. There you didn't have the problem, but like the market adopted this RETH and wrapped staked ETH as the next safe place. And so what we did, you have like three branches of these collaterals, and they are managed quite independently. So the system detects if people kind of trust this collateral less, it will shrink faster. But if you redeem, you get from all three markets, but it's split up. You can't choose because also the stablecoin is backed by all these collaterals. And you could say, yes, it introduces a bit more risk, but if you compare that with what other stablecoins are backed, it's still amazing. Kind of if you see all these collateral that other stablecoins have, you can't even redeem. And if one of those fail, the risk is much greater. So yes, I agree. So you can't choose, and you get it in a proportion, but it's still way better than I think any other DeFi stablecoin that is backed by crypto, because then the crypto needs to be a collateral that is probably less pristine than ETH and the two biggest staking ETH derivatives.
I hear that, but kind of in principle, kind of like if one of those liquid staking tokens were compromised, kind of like I'd get a haircut by kind of getting a proportion of the collateral back in a compromised token, right?
Yeah, you have that risk. You wouldn't have that in ETH, and then kind of it could happen that the protocol can handle some things so that this branch just shut down and tries to reduce as much bad debt as possible, and then it's kind of turned off. So it's built with that in mind. Of course, you don't want that, and if it's catastrophical, it's 50% is wrapped staked ETH, and kind of wrapped staked ETH loses 50% in the value. Yes, the system has a problem too.
Yeah. We already touched upon this lightly earlier. So kind of Liquidity is notably governance free and immutable, right? And you already said that kind of this was super important to Robert. Why was removing discretion, and by that also emergency controls, so important? And I mean, basically because it costs you flexibility, right?
Yeah, sure. And everybody makes that compromise. But from a user perspective, what people like about Liquidity, you have this predictability. You don't have to check every 2 weeks. Is it updated? Has the parameter changed? Under the hood, some of the big protocols are doing quite a lot of updates, which you're not aware. You just think, oh, it's protocol XYZ version 2, but it changed in between. So I think for the user, that gives them also this trust and predictability. And kind of we need to change, but we need to change in the hard way. We need to redeploy the system, and people need to get out. And but this gives the users also this guarantee that there is not a governance that can change things and somebody else in control of it. So I think it was really with this ethos enabling sovereign users with sovereign dollars without anybody being able to interfere with it. And also because it's more efficient, I don't know, MiCA, I just saw these numbers recently. They have 100 people, budget of 30 million managing that. Of course, they have real world assets and probably do a lot of stuff, but it's just beautiful to see that Bolt, to manage a stablecoin, don't need any of that. And it can work, quite well.
How many people do you have in the company?
Yeah, so we were usually around 8 to 9 people. Half of it developers, and the other half more operational or business side, marketing.
Mm-hmm. That really is a pretty smart team. Tell me, in some sense, I mean, I understand kind of the ethos of kind of having this very pure only kind of stable coin protocol, right? So kind of, I mean, this is also why people loved single collateral DAI, right? And kind of when multi-collateral DAI kind of appeared, there was definitely blowback from the ecosystem, especially when then kind of it became at some point 80% USDC backed and so on. On the flip side, if you look at the outstanding amount of stables for MiCA and Aave, they're also orders of magnitude bigger than Liquity, right? Kind of like I checked earlier today, and kind of you guys have 30 million in outstanding Bolt, and MiCA and Aave are 300 times bigger or so. Maybe I'll look up the numbers of how big, but it's in the many billions, right? So kind of seeing that kind of Liquity is more efficient in some ways. What do you attribute this to?
That it's still so small?
Yeah, comparably small.
Yeah, I mean, it's really hard to scale a DeFi stablecoin. So yes, MiCA is big, kind of first mover advantage, and some, like USDC and USDT, a lot of first mover advantage. Although you shouldn't compare the lending market size with the stablecoin size. So the stablecoin size is smaller, still much bigger than Liquity. But all these DeFi stablecoins, say Go, Curve, FX, they are around 30 to maybe 300 million. So they are way smaller than the more centralized ones. Yeah, I think mainly, I mean, the big ones are USDC and USDT, and there it's quite clear why they dominate, because they're integrated, you have all this utility, and it's just so easy. And for every new stablecoin, it's very hard to get distribution and adoption. But that's why I also think some parties, yes, of course, it's much easier to have USDC, but I think also some people are maybe not aware of the differences between these Cefi stable coins. And I usually compare it, like the car with a combustion engine. These are, if they are built well, these are government market money funds that just are tokenized fiat products on chain, versus the car with the electric engine, which looks like a car, which drives like a car, but is built completely different and has other product properties and other risks that could be interesting. And I think a lot of people are not aware of it, or still maybe, kind of trust the traditional system more. But I still think, to me, why it's important is that it adds a new option that you can opt out of traditional rails if you feel like that. And I think there they can shine. But usually they only shine if things go south. If things go wrong, you hope these things are there. We had the moment with USDC when it depacked, where LUSD was great and a lot of people switched to it. Yeah, but to answer your question, yes, it's very hard. It's a very competitive market. But that's why we tried with Liquity V2 and Bolt to have a very clear and distinct value proposition, rather serve a niche, but be very clear. So, I think you have the traditional TradFi stable coins. They can be fully regulated, safety through regulation. Or I think on the other hand, you have Liquity and Bold that takes out as much as intermediary as possible, and you trust the code. And you have these two extreme. I think they have a value because they give you safety from different sides. And we rather are totally on the spectrum and rather a niche than somewhere in between. I call it the trust me bro zone, where kind of people are just adding risk to it, either by introducing a multi-sig or being a hedge fund, not regulated. And there it's a very grayish area. I think that we'll have a hard time when regulation kicks in. And there we also see the advantage that they say, hopefully we can stay outside of regulation because there is nothing to regulate. That's a bit a long answer, but it was more why I think it's important, why I'm passionate about it, why I think it's a genuinely Ethereum native product, can be only built on Ethereum in that way, and why I'm passionate to build it and further drive it. But it doesn't make it easy that people understand it and value it for its proposition, especially like you and me, we live I think you live in Germany and in Switzerland. We have great financial systems, we have good governments, so we don't have this immediate need. But I think maybe from different countries in different regions, that looks a bit more different.
I hear the spectrum. So kind of, I fully understand if you hold USDC, you kind of trust that Circle is sufficiently regulated and they kind of have the deposits they say they have. I also understand, look, it's maths. You can check it out on chain argument that you guys are driving. I'm not fully caught up yet on the value proposition that you were referring to. I understand it kind of appeals to a different set of people, but who's your customer? Who do you want your customer to be?
Yeah, I think there are three customer segments, I think, for whom this can be interesting. So first of all, what are the properties? You talked about the USP. So I see three areas. One is no exposure to TradFi risk. So Bold, by the way, was rated by Blue Chip. That's a rating agency that rates stablecoin. And it was the only DeFi stablecoin with an A rating, A minus to be precise. And the only one in the A segment without counterparty risk, because there is no counterparty out there. So I think for people that look at that and say, hey, safety level, I can have a centralized version where I have counterparty risk, or I can have this DeFi version without counterparty risk. So TradFi exposure is counterparty, collateral, centralized exchanges, all the kinds of risks you are taking on to get the yield, kind of taking out all these intermediaries. And I can tell you now for whom this is interesting. But that's the first really differentiator. No other stable coin provides this kind of risk profile, and it's good for diversification. The second thing is people that want to have more control. So what Bold also gives you is more control over, for example, the stronger property rights. There is no freeze. You can directly mint and redeem. With a lot of stablecoins, you can't do that. You need to be a corporation. You need to be onboarded. You're probably the last one in the queue. So that's another one. You get more control and also predictability. Nobody changes the terms. So in Liquity, for example, me as a CEO of Liquity AG, I don't have more information and control over this product than you have. So I think that's also something unique, level playing field. So we have no transfer exposure, more control, the full transparency and predictability because everything is on chain. So I think these are three propositions not many stable coins have. And you as a user, you just get a stable coin, you know that it's built with the best interest in mind, the best user interest. So for whom is this proposition, if this is the differentiating factor? I think three people. One is, of course, the self-sovereign individual that just say, hey, I want to also hold dollars, maybe dollars of last resort, where there is not a government, where there is not a jurisdiction that can interfere, and I have strong property rights, like I can hold Bitcoin, I can hold a digital dollar that doesn't have ties into the traditional system. And that values this control, transparency, and being able to exit into ETH. With Bold, you can anytime exit to ETH, which you probably feel more familiar. And you're again in your world without needing to hop through traditional institutions. The second one is, I would call low-risk DeFi yield seeker that says, hey, I would like to have some decent yield, borrowing fees, native DeFi yield, but I don't want to have the risk with all the other stable coins in the trust me bro zone, where people just are exposed to 6 different protocols, where you have 5 different stable coins, where it's looped, where an team is running it. This transparency of the yield, and I think this good risk-adjusted yield for people that are more looking for a passive saving accounts or like DeFi treasury qualities, like you want US treasury yield. I think we are close to DeFi treasury yield. So this would be the second one. And the third one, treasury and asset managers that want to have a risk diversification. So imagine you have 99% of your stable coins in USDC and USDT, and we saw the USDC kind of Silicon Valley Bank drama. You could say, hey, I don't shift everything, but having 5 or 10% in a totally different risk profile with an uncorrelated yield, not treasury yield, could be an interesting play, like you diversify your portfolio. I think these are the USPs and target segments that would be most open. And obviously, these are crypto native ones. I think for every new crypto users, probably USDC and USDT is totally fine, I think. But then the next level, if you start touching all these different stable coins, I think you should really think of how much risk you're holding for that yield. And there, I think we're just a very simple, a very clear and very honest play. And I think people that want to have a bit this peace of mind, I think for those, we're a good alternative.
Over the last couple of years and months in particular, holding US dollars had its own risks, right? So kind of if you look at how much value the US dollar has lost deliberately by most accounts, it was not a good time to kind of be a USD holder. Have you thought about, but I mean, the fact remains that 99% of the global stablecoin market is US dollars, right? Is that, on your side, is that a design choice or is it a historical accident? And are you thinking about supporting non-USD denominated loans in principle?
Yeah, I think the decision was it's just the dominant currency. Like it's the world currency. DeFi is denominated in that, so it makes a lot of sense. But that's the current time. That's why I think models like Liquity or others, really crypto native stablecoin, are important, that we have these crypto native products that are on the crypto rails, that are not dependent on traditional rails, that in the next step, today we are USD denominated, maybe we can decouple from the dollar. That will be the next natural step. And for that, we need kind of these kinds of designs and these kinds of stable coins that are backed by crypto and can decouple also from the dollar. I think that should be the future. We don't have plans. Rye did it, and maybe now would be a better time. Maybe they were too early. Now with, as you said, like the dollar and all these global financial market shakeups, now would be the time. We don't have the plan, but I think it will happen and it makes sense. And that's again, I think it's important that we have these stable coins like with electric engines rather than the combustion engines. Because that's why we set out, that's why we started to build on Ethereum, to have our own financial rails and our own financial products and take finance also in our own hands, not doing everything, but just kind of being able to opt out if you think just things are going too crazy and in a direction we don't like.
What are the fiat options you would be considering if you went in that direction? Is it any one particular currency, or is it a basket of currencies, like special drawing rights, or where do you think the ecosystem is going to go post-dollar?
Yeah, I think post-dollar, more from a global perspective, I think we're entering a time of dollar losing the dominance. And maybe it's a multi-currency thing, something new. So I think it will be very interesting if we can have that, or crypto has a bit its own thing. I think that has potential. Other than that, very difficult to say which currency. Of course, I'm Swiss. I like the Swiss franc, which is a great value. And there is a project called Frankencoin that does that. So I think it's interesting because a lot of people should be interested in it. It's a bit a harder model, especially if you want to do it centralized, because if you get no interest or have negative interest, the business model doesn't look so interesting. And Frankencoin is doing a great job, so I really love them. But it's also really hard. It's a much smaller market and bootstrap that. So I'm happy with what we have, and I think I rather take what we have. I think we have a good product, and look that we can get more adoption, some critical mass, so the project can sustain itself. As I said, and I think there we also need the support of users and the community, not only Liquity, but also other stable coins. These things are not used. We won't have the options when we need them. And then we only rely on the other options.
There's also a Liquity token, right? Can you shed some light on what the token actually does, and just as importantly, what powers it doesn't have?
Yeah, so with Liquity V1, it had actually no power unless you could stake it and earned the revenues out of the protocol, so the fees that were generated. And with Liquity V2, because we said it's a continuation, we wanted to give also value back to the LQTY holders. As we recognized, in the system, the borrowing fees, we shouldn't give it to token holders like most stablecoins do it. And then it goes into the DAO, and then they realize if they don't give it to the stablecoin holders DPEX, and they have this complicated system, probably of 100 people that figuring out where the interest should go. So we funnel that through. So we thought a better mechanism there, how we can get value back to LQTY is, out of these 100%, 75 goes directly to the stablecoin holders, which deposit their stablecoin into the protocol and get this DeFi native yield, which was 3-4%. And because we had ETH liquidations, that spiked, since inception, it had 6 to 8% yield on a DeFi native stablecoin. So I think that's pretty cool. But going back to LQTY, and 25% goes to the liquidity venues. So also something very innovative. Liquity recognized that you need liquidity. So borrowers are paying for stablecoin holders to give them credit, and they should also pay for liquidity, because every protocol needs to pay for liquidity. You just don't see how it happens again. And Liquity made that transparent. 25 goes to LP pools, where LQTY holders can stake their token and they can direct where it goes. And with that, of course, the idea is when it grows, you control 25% of the revenues, and to which LP pools, with which pairs, you create a bribing market on top. Right now, it's probably too small, but we've seen first steps, and that can become then also a revenue source for LQTY holders.
But you guys, as Liquity AG, you don't partake in that revenue. So kind of how do you guys make a living?
We have some treasury tokens. So in V1, we also staked, and like any other person could participate in that. We're also incentivized indirectly of the value of LQTY that others get of it. I think that's also the main thing. And Liquity was always set out to be rather self-sustaining. So not kind of to grow and make it bigger, but rather have really a small team, and maybe even a shrinking team that and the protocol should sustain itself. So, out of the liquid LQTY revenues, some of it we use to make the runway longer, but these were actually the funds to bootstrap the protocol. And the idea is not to grow it and make a bigger team, but rather make it self-sustaining. So we are not set up to have this continuous big revenue stream going forward.
Are you worried that Liquity might end up under-resourced compared to systems willing to extract rent?
No, because it doesn't need, what would it need the resources for? Now it's only growth. So yes, I think that's why we invest into growth, to get it to the critical size. But again, even with the liquidity, we build it in a way that LQTY stakers and the protocol can take care of it and bring it to a size where it's sustainable. So this is really the goal. I think other teams, of course, they can extract more value out of it, MiCA, just because of the size. But I'm not sure if you then can achieve that much more. Kind of there is only some limitations. Or you can buy your success. That's what most projects maybe use it for. You buy TVL, you do all these deals, and then it looks great. But the moment where it goes away, everything is away. So we tried at rather smaller steps, but organic. The protocol needs to sustain itself. And that's the main goal right now.
Is there a point where you think kind of this freeness of governance design becomes dogmatic rather than principled?
Why do you think so?
I think there's a reason why a lot of protocols choose to be upgradable, right? Kind of like you want an emergency off switch. You want some discretion, kind of like you don't. I know that in terms of the smart contract set, Liquidity is a lot less complex than, say, Aave V3 or something. I mean, there's kind of just pure lines of code. So it's less likely that something is wrong. But even if you take, for instance, the recent balancer exploit, right? Kind of like it was in code that had been battle tested for 4 years. Kind of there were hundreds of millions of dollars in it. In the end, it was kind of a maths bug, right? And someone found it after years and years and kind of like it was exploited. So I think the idea that you can write code so perfectly that you don't need a fail-safe switch. I totally understand your qualms with governance. Governance is a complete pain in the neck. Yeah, I mean, so basically, make a governance is dysfunctional. I mean, everyone knows this, right? And kind of like Aave's less governance and more politics. I fully understand why you wouldn't want to subject yourself to that, but going the totally pure way in the other direction, it does have its risks, no?
Yeah, and I think, there are different ways how you can do it. I think the ethos should go into the right direction. I mean, why are we building on blockchain? Exactly that not 3 token holders can decide and kind of upgrade the whole system within 10 minutes. I mean, that's why we build on blockchain. Otherwise, we can also build that in Web 2. And of course, we are a bit extreme, but I'm not saying that everything is bad, Pause switch with good governance and can make a lot of sense, and you can introduce that. Or these time locks that you have on voting can make also a lot of sense. And there are areas where you can't build it in an immutable way. I mean, that's why we also built the liquidity provisioning, where the liquidity goes, that we built it in a more dynamic way, where LQTY stakers can decide where it goes. So we recognize we can't make that immutable, but I still think there are a lot of good ways how you can design it to protect users and not take advantage of it. I really like also the curve model. Let's drive a very nice balance of we can change some parameter, but we can't take away funds, we can't do much. We have a kill switch, and otherwise we can upgrade. Also this ethos saying, if we find something, we can create a new version and people can decide if they want to move and we don't force them. And I think that's the things I like about decentralization, and there is a lot of wiggle room. And it doesn't need to be pure. But I think we want to give the users the control and safety that blockchains provide in the best possible way.
Okay, I think that's a very fair take. If you now kind of zoom out, the global stables market has absolutely exploded over the last couple of years. What are the thoughts that you have when you see that? What are the challenges that you see? What are the topics you think about?
Wow. Very open question.
It is very open.
So I mean, but what I see is in the past we had just this continuum of stablecoins, and everybody could do things. If we had Terra Luna, we have a maker model which was fully crypto, now has real world assets. We have people that tokenize carry trades. It's a bit the Wild West. And I think the biggest thing I see is that clearing up. And as I said, of these 2 models, you have these regulated ones in MiCA or Genius Act, Clarity Act, which makes a lot of sense. You want these treasuries in the most safest way, and we know how it's done in TradFi on-chain. So I think we'll see these models gravitate to that. That will become a commodity. You can't differentiate that much. And then you will have the fully decentralized one, which hopefully will survive because regulation will say, okay, that's something genuinely different and there is no intermediary, and that's fine. And the all in between, the trust me bro zone, where you just could operate, I think there the air will get very thin unless you get the right licenses, because you can't tell me that you can do anything in between where you're not controlling users' funds stuff like that, which is probably clear that like in traditional finance, there needs to be another setup. So I see this clearance, I think, of the picture. I think it will be really interesting on the centralized ones. You have USDT and USDC, but what happens next? And there I really like the model. By the way, it was a great podcast with Zach from Bridge, which makes a lot of sense. There it's just a commodity. They provide the commodity, they take a fee, no thrills, because the product is simple. But the interesting part is, what are people able to do with the yield that they get? Which players can monetize that and create the model? And for example, Bridge is issuing native markets stablecoin on Hyperliquid, and there we already see people need to use this yield for distribution and liquidity, like Liquidity. That's what we use it for. And we will see their models that might work and that will create new stablecoin incumbents that will be able to survive in the space. So that's about the things that I see moving, changing, and that will be interesting. And on the decentralized one, our electric cars, I hope we see more adoption there, more recognition, and that this is another model, a model that should survive, and hopefully, and I think also as an ecosystem, we need to fight for it, that people not just say, hey, this is dangerous, like self-driving cars, oh my God, we should avoid them, because we have built a self-driving credit system. And people might be afraid of that. But I think just that still these things are possible, because I think it should be a right that you and I can facilitate peer-to-peer finance. We shouldn't be forced that this has to be done in an intermediate way, because it wasn't the normal way. Before 200 years, before there were banks, that was the way how you did finance, and it was totally okay to do that on a peer-to-peer level.
I hear that. And I kind of just to be clear, I fully subscribe to that. So it does really appeal to me. So kind of I also really like single collateral, DAI, and so on. I also like RAI. So I know which camp I stand in. Zach also said something else interesting on the podcast, namely that he kind of sees banking and stablecoins kind of converge rather than having kind of two parallel financial systems in perpetuity. Do you think the user base of Liquidity is going to evolve? Do you think at some point JP Morgan will have Liquidity positions on their balance sheet?
Hey, could be. I mean, from a risk diversification point, and also it's interesting because there is no counterparty. So there's maybe not the AML topic. So we had Bitcoin Swiss in Switzerland that facilitated direct loans with Liquidity. So not on their balance sheet, but they just facilitated directly with Liquidity. And that was possible in a regulatory way because there was no counterparty to it. It was the protocol that issued the stablecoin. So these models can have some advantages. Also, institutional players really like the predictability, that maybe they're not reliant on a MiCA governance and what happens there. So I think they're not going to shift to it. But as I said, as a risk diversification, adding that to the portfolio, if they understand it, I think that could be interesting. And on the other side, I'm not sure what Zach said there, but what you see is now banking is under pressure. The banking model with these tokenized treasuries, stable coins, they are eating really their market. So I'm really interested to see how this will evolve, because banks will see people move their money to these stable coins. Because honestly, a PayPal stablecoin is a much better product than having your dollars in your bank, because there you have the counterparty risk, and this bank, in Germany, might lend the money to Benko. We had this huge scandal, and you're not aware of it. And with Paxos, your money's parked, and you get a yield. So with banks, they give you the risk without giving you the yield. So and we see these forces now playing out with Genius Act, with Clarity Act. Honestly, it's not about the users. What they are arguing about, who should get the yield. So regulation is actually used to protect the banks or create the moat, which I think is a bit paradoxical. And then just want to highlight it, that I think half of it is regulation is used to protect the users, but half of it, sometimes it's also to protect incumbents. And the same for MiCA. MiCA, I don't think they made stablecoins better or less risky for users because they forced, I think, EuroC to hold more of their backing in bank deposits, where you take on the counterparty risk of banks. So that was really questionable to me.
That's an interesting take on the regulatory side. Can you give us more specifics of how you think the Genius and Clarity and MiCA Act, how they protect banks? Is it just that they disallow the passing on of yield? Or what is it specifically?
Yeah, exactly. I mean, that's something I learned with crypto, how a bank works. You deposit your money, you don't get any yield, and they can lend it out with some nice interest, with leverage. These are the digital
Many
traders.
times over, right?
Huh?
I mean, kind of like they can lend out like
8 times leverage.
what they
We
have.
think these are digital crypto traders. No wonder they need regulation. So that's a very risky business model these days, especially if people can just with a click move all their money out. It's not designed for that. Kind of duration of risk is not managed like that. And so there I see really disadvantage. Now I have a product where I can deposit my dollars, which are held bankruptcy remote, and I still get the yield. So, I mean, I would be really dumb if I wouldn't use it. And now, I mean, these products are government market money funds. They are aware. I think with Fidelity, you can open such accounts. It's nothing new. I think crypto just adds new rails, makes it, for example, for me easier to get access without my bank and be able to use it in DeFi and repackage and rebuild it. So I think that's great. But I think that's what I message you. I learned with crypto that not every dollar is created equally and how different all these dollars are, especially from a risk perspective. Going back to this blue chip rating, what I also learned is, for example, USDC is only B+ rated because with USDC, you still have some counterparty risk of Circle. I wasn't aware of that. And PayPal or even Ripple USD dollar is better because it's bankruptcy remote and it's a better setup. So these things really matter. And going back to your question is, I think breaking up this banking model, they just got this deposit and could lend out and taking the spread. I think that's a bit breaking up, and everybody says they're afraid, saying, okay, credit for small businesses will be very difficult. But honestly, most of this money went into hedge funds or a lot of other stuff. And now I think just these two markets, getting yield on your deposits and getting paid to lend out your money, will be priced differently. So I think that's the pressure on the model that I see, that these stablecoins now will offer to more users, and banks are afraid of bank deposit flights, exactly as you said it, because now they're getting more yield on their dollars somewhere else.
If I turn this argument around, kind of if I'm a small business owner and kind of I want to get a loan from the bank, what they do is kind of they look at me and my CV. They look at my business plan, and then kind of they do some sort of risk underwriting to kind of see whether they think I can make this work and whether they can kind of make their money back with interest. Kind of in Liquity, I actually need some sort of, actually very specific capital, i.e. ETH, in order to actually get a loan, right? So kind of this entire under-collateralized loan space. Kind of, I mean, we don't actually have to talk about the in-between stages where kind of, say, for instance, in MiCA, kind of you deposit RWAs and so on. But kind of the really under-collateralized end of the spectrum is where most loans actually take place, right? Everything, more or less everything that's not a mortgage is severely under collateralized, right? So how do you see that kind of migrating into the trusters realm, or do you see that migrating into the trusters realm? Because kind of I actually see that as the main skill set of banks that they have become very good at risk underwriting.
Exactly. And it makes totally sense that they make it. So I'm afraid, that's what I said. If I hold a stable coin and now some crypto team is giving under-collateralized loans to market makers, I think then I take a lot of risk. And that's why I said, okay, maybe I'm just fine with 6% on Bold by not taking on all this risk. Because that's an old business. Underwriting business and traditional banking is very good in that and should be done by these people. And the role that crypto can play is that you say now depositing stablecoins or funding such companies that can underwrite the loans is now much easier, much more direct. So we already some years ago, I talked to invoice financing companies that instead of getting a credit line from a bank would take credit from crypto investors. And I think that makes a lot of sense, as long as you kind of have this regulated business and you're doing it in a diligent way. But then again, blockchain and crypto just become the distribution channels or just the digital channels or rails for traditional financial products.
Cool. So, Michael, tell me, what's next for Liquity? What should we watch out for?
Yeah, so we are really focused on building out the ecosystem and the utility for Bold. So being it, kind of integrated in lending markets, and then really beating the drum that people see this proposition, understand that they get a stable coin that can have the similar risk profile, like even better than USDC and DAI in this blue chip report that were B plus and Bold is A minus, and getting a good yield and start using it. So that's really our main focus. The product is out there and now it needs to be used. So we are really focusing in educating people, understanding the product proposition, the good yields we achieved. So that's, as I told you, you have the borrowing fees. But if you deposit the stablecoin, you also partake in liquidations and you can make 5% gain. So in these markets now where there were liquidations, people earned great returns, and just making them aware of that kind of in this very risk-adjusted way, these are great earning opportunities. That's really our main focus, driving growth, driving integrations and utility. And I think that's the blueprint of every stablecoin holders, and that's really also the challenging part. Deploying the stablecoin is always the easy part, and we see that we have a lot of forks. Actually, our model gets forked quite a lot, and deploying it is the easy part. Building a user base, building utility is really the tough part. So that's our full focus.
So where do we send people to find out more?
Yeah, go to liquity.org. There you have the website. There you can inform yourself. There you find front ends, because even front ends are decentralized with us. So you have different front ends. There you have very great and deep detailed docs. And we have also a Twitter channel. That's the main communication channel. That's at Liquity Protocol, where you can follow us, learn about us. Yeah, and help to push sovereign money and Ethereum dollars.
Fantastic. That's a fantastic way to go out today. Thank you so much for joining us, Michael.
Thank you, Friederike, for having me.